With rising interest rates and higher oil prices, 2023 has been a challenging year for responsible investment. And alongside headwinds to performance, we also saw persistent confusion around terminology combined with a political backlash in the US. But despite these concerns, we believe the case for responsible investing remains strong. What we do need, however, is increased clarity and focus. We firmly believe that positive financial outcomes are more likely to be achieved if we fully understand the risks and opportunities surrounding the investment decisions we make. And now, more than ever, environmental, social and governance, or ESG factors, are key components of this understanding. Take climate change as an example. 2023 is expected to be the hottest year on record. Extreme heat waves, deadly wildfires and devastating floods remind us of the need to factor physical climate risks and opportunities into our decision-making. We've seen interest in responsible investment explode in recent years. This is great news, but the wealth of options can be confusing. ESG integration, for instance. Many of today's European investors already take consideration of the ESG factors within investment processes as a given. And there are many strategies now vying for client attention. But with this expanding choice comes scope for confusion. We've seen the ESG acronym become a proxy label for sustainable investment. But are strategies really championing sustainable industries and leading companies, or are they simply ESG integrated? We believe our industry needs to be more disciplined around the language used, coupled with carefully listening to what clients are aiming for. It's important to really understand desired client outcomes and then use our capabilities to either develop appropriate solutions or signpost to existing ones. This is an increasingly key area of focus for us, and I'm delighted we've launched several new products this year, and we have more in the pipeline. And I expect this trend of innovation to continue. We're seeing a rapid evolution in the regulatory environment, with product disclosure an area of keen focus. In Europe, we already have SFDR, and comparable rules are on their way in the UK with SDR, and as well as in the US. We welcome any efforts to improve transparency around responsible investment and counter the threat of greenwashing. Of course, keeping up with fast-changing regulatory backdrop can be challenging for clients, and without consistent definitions or terminology, there remains much room for interpretation, which isn't necessarily helpful. So what can we do to help? From our perspective, it's all about being clear and open with our clients. We focus on the integrity and quality of products alongside being transparent about what we can offer. Proactive engagement and thoughtful voting are integral parts of our responsible investment approach. And going into 2024, we'll be working around defined thematic priorities which will inform our objectives and dialogue with both companies and issuers. We've already talked about 2023's extreme weather, and physical climate risk will be one area we're certain to focus on as the issue becomes increasingly material. Our dependencies and impacts on nature also need to be carefully considered. Ecosystems underpin the world economy, but many are threatened by our activities. So we'll be working closely with companies to learn more about how they're managing nature-related risks and opportunities, and we know there is much work to do here. We're also set to have a particular focus on water. Demand is growing, but at the same time, climate change and pollution are increasing pressure on water resources. Given the obvious risks for businesses and society, we'll be exploring this issue across different industries and value chains. Beyond the E in ESG, we'll be focusing on diversity, both within our organisation and our investee companies. And on human rights, we'll be working towards a more systematic approach to identifying and managing material risks within supply chains. We'll also be looking to get more sophisticated and consistent around our analysis of human capital management and keep focused on corporate governance as a key fundamental factor. Board refreshment, for example, is becoming increasingly important when managing a volatile regulatory and geopolitical landscape.